Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
I'm sure you've heard the old saying, what goes up must come down, but I bet you haven't heard this one. What goes up might just one day flatline.
Welcome to the only show in the country dedicated to helping savers worry less about money, the WorryFree Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Retirement. It's kind of a funny concept when you think about it. In the annals of history, this whole notion of stopping work at some predetermined age and never to work again is relatively new. As I covered more than 20 years ago in my details of the documentary Say Goodbye to Granddad's Retirement, prior to the creation of Social Security in 1935, most hardworking Americans didn't even think about retiring from work. No, they just kept working until they no longer could work. Well, not so today. With the invention of Social Security, the replacement of guaranteed pensions with employee-funded 401k plans, and people living longer than ever before, retirement, and the many financial institutions are now jumping on the retirement planning bandwagon, is all you hear about, which, seeing as though we've specialized in retirement planning longer than most, is fine by me, as it keeps us in business and allows us to serve the needs of thousands of savers who are already retired or thinking of retiring in the very near future. Yet, there's a problem. How does a saver who has been saving all of his or her life all of a sudden stop working for a paycheck and then try to figure out how to turn that 401k into one? And of course, all the while, not running out of money in retirement. Well, I'm certainly glad you asked. Well, welcome folks to the WorryFree Retirement, and yes, I'm that little man in the sweater vest, retirement planning specialist and the world's friendliest financial fiduciary, Tony Walker. And today we're going to address the most common questions we receive from savers who are already retired or thinking of retiring soon, and how we at Tony Walker Financial more specifically address their concerns over having too much money in the stock market during this thing called retirement, and of course falling victim to what I call the next flatline effect of the stock market. But before we dive into this subject, let me introduce two young lads in the WorryFree studios who better not flatline on me just yet. America's favorite financial sidekick, Mr. Aaron Orender, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. Okay, let's get back to the original question I asked at the very beginning of the show. Have you heard the old saying about the stock market? What goes up must come down. You have? Well, that's good. So, what that means is with anything in life, if you toss something up in the air, gravity will eventually pull it right back down. And as we can see from this graphic of the recent history of the stock market, you can see that the stock market has followed this rule of gravity on frequent occasions. But I bet there's something you did not know about the stock market, and that is something we call the flatline effect over time. Look closely at these years between 2000, a major decline in the stock market, all the way until we get to the year 2015. Notice that if you had money in the stock market in 2000, over all that roughly 15-year period of time, with gravity bouncing the market all around like a yo-yo, 15 years later, you would still have the same amount of money. In other words, your overall returns flatlined, leaving you with less money than when you started when you figure in the effects of inflation over that same period of time. So what does this flatline effect have to do with those of you who still have most of your life savings in the stock market? Well, when I return, myself and our own Wes Walker will tackle some of the most common questions we receive each and every day from savers who are worried about having too much in the market during retirement, and what can happen to the amount of money they now enjoy if this market flatlines in the future. So if you're retired or retiring soon, worried about that money in the stock market, and don't have a game plan in place for the future, stay tuned because this is some good stuff coming up. I'm Tony Walker. This is the WorryFree Retirement, and yes, we'll be right back. This Tony Walker Financial 5-star review comes to us from Brent. Had been with a captive planner for several years, but felt they had grown complacent and the fees were too high. We never thought we'd do business with a TV radio advisor, but we'd caught some of Tony's broadcasts and he definitely made sense. So we gave him a call, sat down in person, had him prepare a game plan, met his staff, and decided to give him a go. Great decision. Their customer service is outstanding and we are pleased with the results. Granted, this is a saver portion of our portfolio and he is not the firm for risky investments, but he will tell you that up front. In addition to the financial side, Tony's philosophy of live well, die broke, he really doesn't mean completely broke, woke us up to the fact that we should enjoy money while we still can and not be held hostage worrying about it. If you'd like to read more of our 5-star reviews, simply log on to TonyWalkerFinancial.com.
Who can you trust? It's one of the most important decisions you'll have to make. Question is, are you ready? Well, we're here to help at Tony Walker Financial. You know, we care more about you than we do your money, and we have over 3,500 happy clients and an A+ rating with the Better Business Bureau to prove it. Rolling over a 401k, confused about Social Security, maybe you're afraid of running out of money. Learn how to use and enjoy and protect your hard-earned money. Log on now to TonyWalkerFinancial.com and let's get started. To the average saver I meet looking to retire, or in many cases, the savers I meet who are already retired, figuring out how much money, if any, to invest in the stock market during a period of time where they will be retired from work is a scary proposition indeed. That's because savers realize that while nobody can predict what the stock market might do in the future, we can all agree that over the past few decades, there was a period of time between 2000 and 2015 where the market is what I referred to as flatlined. In other words, between that period of 15 years, after factoring in the effects of inflation, one would have lost money by leaving it in the stock market. And it's not just the money you could have lost, but one must assume that if you are retired and not working and dependent on this money to live on, if we do experience another major market downturn in the future, what will the effects be on that money, and how could a future flatline determine if the money one has saved will last as long as you do? Not only is this a scary proposition to consider, but it is downright confusing when most savers I meet are listening to way too many voices on the matter, many of whom are not experienced nor trained in the art of retirement planning. Whether it's the many random strangers on the internet doling out retirement investment advice, the advisors hosting dinner seminars or pseudo-college classes, and yes, even folks like yours truly who are on radio and TV touting their expertise, the thousands of savers I've met in the past 41 years of doing this business still ask the same question. How much money in retirement should I invest, if any, into the stock market? In almost all cases, the problem is not that they don't have enough money. The problem is none of these people have a written game plan, and therefore, not knowing what to do with this stockpiled money, most continue to blindly risk it in the stock market, which of course is no plan at all. So to help us in this matter of better understanding what could happen in a flatlining stock market is fellow fiduciary here in the Louisville office, Mr. Wes Walker. Good morning, Wes.
Good morning, Tony. How are you?
I'm doing great, and thank you for being on. We got a little bit of a limited time. We're kind of running short, but this is a crucial topic because, as you know, I've been here, almost 6-7 years, or
It'll be 6 years in January. Been here a little while.
and you've talked to hundreds of people. This whole question of how much, if any, should I invest in the stock market during retirement is a biggie. So what I wanted to do with you, because you're taking a lot of questions from current clients, is just go through a few of the common ones you receive, and you've kind of fed those to me and Derek. Derek's going to put them in the monitor. So let's get right to it. I like this one. What is the stock market, and why would anyone invest in the stock market in the first place?
Sure. So the stock market in general is just kind of this big amalgamation of different companies. You can think of it as all the companies in the United States or a foreign land or whatever that, index is tracking, all lumped together. That's, in theory, the stock market. Now, to expand beyond that, in the short term, stocks are like voting machines. People vote for their favorite companies. You see these companies run up in price. They have really great returns in the short term because people are voting for them. In the long term, though, the stock market is a weighing machine. It takes those companies that actually have had great results and promote them into higher highs rather than just public opinion as it does in the short term. So it's a very complex thing. It's very interconnected, but basically it's just companies in America and abroad.
That's a very good explanation. Okay. I like this one. Here's another question you pose, and you hear this a lot. When someone loses money in the stock market, where does that money go?
It's an interesting thing to think about. You would think that if you've lost money, that means maybe somebody else has made money, or that you've somehow gotten the rug pulled out from under you. I would think about it like this, if you bought a home and all of a sudden there was some problem in housing and the value of your house could not sell for what it would prior, you didn't really lose any money. You did, of course, on paper, but it's just that the value of that asset is no longer as high as it used to be. So that same principle applies in the stock market. If you've got a basket of stocks and all of a sudden investors aren't willing to pay as much for them as they were prior, you've just had a paper loss and it's not worth as much as it was.
No, I like the homeowner analogy. That's a good one. Okay, so we got a couple of articles to cover. Now remember, our theme is, Wes, this whole idea that the market is always perfect, and it's not. We see it goes up and down. Then we've talked about this concept of flatlining. What's this recency bias all about? This comes to us from Charles Schwab.
Sure. So what finance has moved a lot toward lately is what's called behavioral finance. And it's not so much about the technical numbers behind everything. It's more about the psychology of money and investing. And this is one of these biases that a lot of people have expounded on. Recency bias just tells us that, you might become acclimated to a certain climate and think that that is going to continue forever, when in reality, it may not. So if times are good, people kind of get that feeling in the back of their head like, oh, this is just the normal. It'll always be like this. But that's kind of the scariest words in investing or personal finance is this time it's different. Things can always revert back to worse times, and in bad times, things can go back to being better. So recency bias is definitely something to look out for when investing.
I like that. And then you picked another one here, understanding sequence of returns and risk. And again, let's try to stay in our theme of somebody retiring. What's so important about this?
Well, sequence of returns risk is just a fancy way of saying catching a bad run. So like 2000 through 2002, you had negative market years, during that period. If you retired right prior to the year 2000 and you're watching your money go down year after year after year while you're taking withdrawals from it, that is just a recipe for disaster. And that's what really sequence of returns risk is. If you catch a good pocket in there, like let's say the 2013 bull run through 2016 or whatever, just a good few years, your numbers are going to look very, very rosy because the returns are high. You can take out distributions, you can increase your withdrawal rate, but if conditions are bad, that does present some sequence of returns risk just because markets aren't great.
And that's kind of happening right now, wouldn't you agree? Because we've got a pretty good run as we record this show in October 2025, but and that's only like a 3-year run. Was it 2022? We had a pretty good little hit to the market.
There was, but even that one was, it wasn't the biggest drawdown we've ever seen. So in recent memory, people forget about times like 2008, 2001. You can go all the way back to the 1929 Great Depression. These things can happen. And I think if you're not well suited for it in retirement, if you're not prepared with an income plan, a game plan, it's really hard to navigate those kind of waters. Derek brought up this chart. So this is actually the NASDAQ. So this isn't the S&P. This is more of a tech index. But if you looked and just said, hey, in the year 2000, if I popped all my money into the NASDAQ at once, it would be 15 years before you got back to even. And that's sequence of returns risk.
I got you.
So these kind of things can be mitigated by things like dollar cost averaging, annuity contracts, retirement income planning. That's what our focus is really making sure people can use their money in retirement.
Well, Wes, thank you so much for everything you do for our clients and answering all their questions. Folks, we'll be right back. Welcome back to the Worry-Free Retirement. Tony Walker here, and we have some special guests in all the way from Des Moines, Iowa. We have to my left Mr. Mark Williams and his cohort, Mr. Scott Truca. Thank you, gentlemen, for coming all the way to Louisville, Kentucky.
Thrilled to be here. Thanks very much.
Well, the last time I saw you, Mark, in Kentucky, this was probably 6 or 7 years ago. In fact, we even put a video together.
That's right.
You came all the way to Bowling Green, Kentucky. Why did you bring your crew to Bowling Green? Do you remember at that time?
I sure do. You're a very special producer for our office. We do business with about 60,000 contracted agents nationwide. Every single year out of that 60,000, there's probably 10 or 15,000 that will write a piece of business with us. And you're in our top 1%. And so for us, that's a very good customer. So for me, I still love to see face-to-face. And so that original visit was to come and see you and see your office and see how you work.
So Scott, tell us a little bit about Brokers International. In essence, what do you all do exactly?
Yeah, so Brokers International is one of the oldest and largest independent marketing organizations in the industry, or an IMO. We help distribute life insurance and annuity products through agencies just like yourself. So we provide some marketing support, a lot of back office capabilities, contracting, new business, those kinds of things to help folks like you grow your agencies.
And I really appreciate all your all's efforts, and it's been a great partnership. Now, it's 2025. We're recording this show in September of 2025. Either gentleman, you can step in here, but what changes are going on in your all side of the industry in terms of the supply side, and what are you seeing in the terms of agents and advisors and what they're doing?
Yeah, so there's probably two big trends I'm seeing in the industry today. The first is automation, for sure, technology. The insurance industry was really slow to adopt new technology. In fact, up until COVID, most insurance companies required a signature on an application. Today, they have electronic applications, as you well know. So I think technology is one big shift we're seeing, which is coming all the way down to point of sale for your customers. I'm sure you're showing them software output. Oftentimes, many of our producers are using either TV or radio or iPads right at point of sale. So technology is one big trend. The other is our agents. We have an aging field force. And Scott will talk a little bit about just the average age of the agent and what that means for the consumer.
I love that you brought that up, because sometimes, Scott, people will talk to me. I mean, I'm 65 years old. I've done this a long time. And they say this in a polite way, but they'll say, Tony, this all sounds great, but what happens if something happens to you? So is that a legitimate question for a consumer to ask an advisor?
I think so. I think, for folks like yourself, you're always thinking about what would happen, if for some reason my clients did have to go to somebody else and you built a staff to help support a lot of that. I think for the industry, that's a question we all have to answer at some point. As Mark had mentioned, I did a little research, and the average agent or advisor is 56 years old, which I think is maybe a concern. I think as an industry, we need to start talking about the opportunities that we have to help people here and bring in some of the younger folks and attract them to the industry.
Yeah, I know in our practice, I have my favorite son-in-law, Trey, my favorite nephew, Wes, but I feel very fortunate to have found these young men, because I've got Heather in the Bowling Green office, and she could run the place if something happened to me, but she's, maybe 10 years, who knows what she'll be doing. So what is going on in the industry? Is there any efforts being made to try to recruit younger advisors?
Interestingly enough, the health side of the business, which we don't even offer products on the health side, but the health side of the insurance industry is recruiting heavily. So what Brokers has started to do is really focus on the agent that is in the health market that would like to expand his practice. Those agents tend to be a little bit younger, a little bit more tech savvy. So for us, we come in and we introduce new product lines to the age of client in which they're working with already, helps them increase some revenue, offer more products and services to their customers. So it's really worked out well.
And I know, Mark, you've been in the industry roughly how many years?
36 now.
36. So you've seen a lot of insurance companies out there, been around a lot of them. What concerns maybe should we share with a consumer that's watching this show that goes, okay, these insurance companies and writing annuities and life insurance, how safe are these companies?
Yeah, it's always a great question, right? You're putting your money into a product that you might not use for 10, 15, 20, 25, in the case of life insurance, hopefully a long time. So the first thing you want to take a look at is the stability of the company. And there are ratings and rating services, which I'm sure that you can offer your carriers, but the insurance companies are rated. So that's number one. How's their financial strength? Their claims paying ability goes into that rating as well. The second thing is that every insurance company is backed by a state insurance department. So they are backed by the states. Each individual state has an insurance department, and there is some backing when it comes to funds like that, much like the bank. And something to really feel for your customers to feel comfortable with is no insurance company has ever defaulted on a product. Never. When an insurance company has gone into receivership, other companies come in and buy their books of business. So one of the wonderful things about the insurance industry is it takes care of its own, even those carriers that run into some financial problem.
Good stuff, Mark. Okay, my last question, I'll throw it over to you, Scott. We did something a couple of years ago. I got with my favorite nephew, Wes. I said, Wes, can you do some studies? How many advisors are within a 5-mile radius of Tony Walker Financial in Louisville? He came up, now this includes insurance agents, 2,000 advisors. So my question is, and maybe you can help us here, how's a consumer supposed to figure out of those 2,000 who to possibly turn over their life savings to?
Yeah, that's a great question, and one that I actually just had to cover with my parents not too long ago. They're nearing retirement, and they were asking me, "Who do I go to, Scott? You know, you're in this industry." And I said, "Well, go to somebody that's going to ask you all the right questions. What does retirement look like for you? You know, what does that look like? Travel, income-wise. Do you want to leave a legacy? Do you have grandkids? What's most important to you? Make sure that they're meeting your needs. And then what's the plan going forward? Are you going to meet on a regular basis? What's that relationship going to look like? And find somebody you're comfortable with." And that's the advice that I gave my parents.
Very good. Well, gentlemen, we're about out of time. I want to thank you. I think you came in earlier today. We're going to spend a little more time together talking shop. But thank you for taking time to be on camera. And thank you so much, Mark and Scott, for all that you do at Brokers International for advisors such as us.
Well,
Thank you, Tony.
back at you. Thank you very much for the business that we've done and the collaboration that we have. So really appreciate you being here.
You're more than welcome. Folks, this is the WorryFree Retirement. We'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today.
Welcome back to the Worry-Free Retirement with the money missionary himself, Tony Walker.
Our theme today deals with this interesting phenomenon of what I call the stock market flatline effect, a period of time where the market will go up and down, but over time doesn't really make any money at all, as we saw between the years of 2000 and 2015. Which leads me to discuss this Tony in the Trenches from Dave in Bowling Green, who shared his frustrations with me about his concerns of leaving all of his money in the stock market during retirement. Here's what he had to say. "Tony, I recently got frustrated with my current advisor who I've worked with and enjoyed over the years when she would not respond to my suggestion to move me to safer territory. I reminded her that I'm 65 and I want to play it safe from here on out, but she refused to change my investments. How would you respond to such a request if you were my advisor?" First, as a fiduciary at Tony Walker Financial, we are always going to do what our clients tell us to do. Now, that doesn't mean we might question them to be sure they have thought through what they are asking, but in the end, this is the client's money. And if a client is fearful of the stock market and tells us they want out, we are going to respond immediately and get them out of the stock market. But more importantly, since we are dealing with savers and know that during retirement they do not like to take a lot of risk, we're going to rely on a retirement game plan to guide us as to where to invest this money, not just blindly throwing it in the stock market and hoping for the best. This philosophy, which is so different from the rest of the financial herd, is not only born out of working with thousands of savers over these past 41 years, but it is, in my humble opinion, a very biblical approach to investing one's life savings, especially when one is retired. Because the real question is not how much you should stockpile for a future that is uncertain at best, but how much do you really need to live on in the first place? That's the real question, and one that most advisors and big financial institutions do not understand. And where does a right understanding of God's take on retirement and how much we should have stockpiled for the future begin? Well, it begins with simply focusing on today and making sure you've got today covered. Check it out in Charles Spurgeon's morning and evening devotional, where Spurgeon reminds us of this daily truth where he says, "Sufficient for the day is all that we can enjoy." Translation according to Tony, you only need so much money for what today is requiring of you. And the beauty of leading our own life and setting our own spending goals is this. You don't need me or any other so-called financial expert telling you what you should spend and what you should spend it on. No, what you need is a daily dose of faith that what you have is sufficient for today. I think this is why Jesus had to remind us of the birds of the air and how they focused on God providing for them each day, which He does each day. But still, while today's dollar might be sufficient for today, we also, like the birds of the air, must be responsible for either working for our food or relying on what we've saved to provide the daily sustenance we'll need in the future. And that's where being logical and practical with your money comes in, especially if you are a saver. Folks, just because you made a lot of money in the stock market in your 401k over the years doesn't mean you'll have the same positive experience by staying in the market during your retirement years. And the market flatlines while you're taking money out to live on, well, one day you could run out of money, which I don't think is what God is encouraging us to think about. So how does one strike a balance of investing for the future and spending money as God provides us each day to spend? Well, let me share with you the key to being worry-free in retirement, and here it is. Number 1, know what you have to work with. Number 2, get a written game plan to see how the numbers will play out both today and over time. Number 3, assume that you will not take a lot of risk with your money and therefore only assume very realistic and modest returns as you project into the future. At Tony Walker Financial, we like to use the rate of return of 3% just so we can be very conservative on our numbers moving forward. Number 4, take on the philosophy of Live Well, Die Broke, a tried and true method I explain in my best-selling book that is so opposite of what the financial world keeps telling you to do. And in the end, no matter what you might have, both for today and in the future, settle in on what the Apostle Paul learned about this notion of being content. In other words, no matter what the circumstances and no matter how much you have in the future or today, in Philippians 4, Paul reminds us of this, that we are to be content in all circumstances. And Paul learned this, to live humbly and to know that whatever was going on, whether he was full or hungry, he was going to be content. You know, this idea of living what I refer to as the flatlined life of contentment, where our emotions about life and money do not go up too much when things are going good, nor go down too much when things are going bad, is living a true and healthy life, one filled with God's Spirit rather than being controlled by our flesh. So, dear Christian, the next time you fall victim to letting your emotions get the best of you, yes, even when it comes to investing in risky things you do not understand, you remember these basic principles, and I assure you, you will worry less about money both today and in the future. You got it? Well, good. So let me ask you a question. If we did go through another 15 years of flatlining stock market returns, would you be able to make it in retirement? Probably not. So the question is, why in the world would you be taking risk with your money at this stage of life, especially if you don't have to? Well, the only way to find out is to meet with somebody like me, Tony Walker, a trained retirement planning specialist who has literally orchestrated more than 5,000 written game plans. So to see if we might be a fit, here's all you have to do. Take advantage of something we call the free 10-minute fiduciary phone call, where you and I will talk by phone, and if I think I can be of help, we're going to meet in person. That's right, the owner of the company, to sit down and lay out this free game plan for you to review. Internet not your thing? All you got to do is call us anytime at 877-499-9255. Well, that's all the time we have for today. But you remember, between now and next week, if all else fails, you be worry-free and you make it a good one.